Hello, dividend growth stock investors. It's Colby, the DGI Crab, and it is time for another episode of the Great ETF Race, episode 18. We've got another milestone that has been achieved in this portfolio. So happy to bring you another update on this one. So, guys, the idea with this portfolio was quite simple. What I did was I took 8 very popular dividend paying ETFs and I decided to invest $5 each into each of those 8 ETFs every single Monday, just into the future to see how they do. I reinvest all of the dividends automatically, and the whole thing happens automatically. In fact, I'm doing this on the SoFi platform where I have each of these little $5 trades set to just automatically execute every Monday, or if there happens to be a trading day where Monday is a day off in the week, it happens on the following Tuesday. You get the idea. It's all just totally automated. $40 a week, $5 into 8 ETFs. The point of this whole idea or this whole exercise is to say that, look, you don't have to be a nerd with a spreadsheet like me where you're tracking these individual companies. You can just pick one or two or maybe even 8 different dividend paying ETFs, just dollar cost average into those every week or every 2 weeks, however often you want to set up an automated process, and just watch that dividend income start rolling in. It really is just that simple, you guys. So, what we've got here is our 8 ETFs, and I decided to do this on a spreadsheet just so we can really easily on one screen see the numbers and the metrics that are most important to me. I always stress in this series, you guys, and you can go look, I've got playlists set up here on the channel. The Great ETF playlist is one of these. You could go back and look at the very beginning, episode 1, when I had $10 invested into each of the 8, and you can see how things have progressed from there, the milestone that I've hit. And it's always so important to celebrate these little milestones, you guys. I always emphasize that with this, especially when you're just starting out. Don't look at your forward annual dividend income and see a small number there in those first few months and get discouraged. It does take time to build this up, but you've got to celebrate those little milestones. When you accomplish them, acknowledge them. It feels good to have those little victories, and then just kind of set your sights on what the next short-term milestone is going to be. That can keep you motivated, especially in those early years. So right now, $300 invested into each of the 8 ETFs. It's always nice to hit a nice round number here in something like this with your invested capital here. And even 300 invested into all 8 of the ETFs. They are all in the green, as it turns out. So I'm up on all of the positions. And again, dividends that have been received over the course of this time have all just been dripped or reinvested back into the ETF that paid out said dividend in the first place. So our order here is BYMI, our non-US counterpart here, is way out in front yet again. $53 up overall. They're going to be further aided by the fact this is one of the highest yielding ETFs in this collection as well. So VYMI, wow, they say that it's always a good idea to have a certain percentage of your portfolio dedicated to non-US stocks, and there's a lot of debate about what that number should be. I've fallen on about 5%. That's what I allocate to my VYMI position in my primary portfolio, is to have about a 5% exposure to the non-US stock market and get paid a good solid dividend, and have a bunch of companies. That's the reasons why I like VYM. It's performed really well. It's just kicking everybody else's butt right now in terms of that overall performance. Then we've got this glut here from second place down through fifth place: VYM, DGRO, DHS, and VIG, all really within a couple dollars of each other here. They've kind of been flipping positions around between the 4 of them here for a little while right now. DHS, the Wisdom Tree dividend yielding ETF, is the only one of the 8 that pays monthly. So far, there has been 62 cents paid out. That was from July. Here towards the end of the month, which is when they typically pay out their monthly dividend distributions, there's going to be even more that goes in, and DHS will have a little bit of an early edge, I would think, just because they'll have gotten a couple of little monthly payments in there before the other ones pay their quarterly distributions. Definitely excited about going over all of the distributions after Q3 is in the rearview mirror, and then we can look and see what each of the 8 funds needs to do in Q4 in order to beat the previous year in dividend payouts, which is something that a lot of these really need to do and do a better job of than they did last year, just sort of across the board. All but VYMI and SCHD delivered pretty disappointing dividend increases. DHS, in fact, had a very slight reduction in its dividend payout. So, anyway, definitely opening for dividend increases. That is the name of the game. And then after our top 5 here, there's kind of a gap, a $5-6 overall value gap between that group of 4 and down to VBR, our small cap value ETF. Then another gap of about $5-6 to SPYD, and then another gap yet down to last place SCHD. So the woes for SCHD continue. A lot of speculation and content going around out there right now as to why that may be. I think long-term SCHD is still an absolutely fine investment. I do think that if you are a younger investor, certainly under the age of 40, you probably are going to be able to find a lot better success in things that are more growth-oriented, whether it be S&P 500, whether it be things like VIG or DGRO, if you're more of a dividend growth-oriented investor. Think that you're going to get more consistent dividend growth out of those if you're looking at very long-term, decade plus, than SCHD. But SCHD's been the king for when it comes to dividend yield and growth combination over these last 5 years. The share price has been stagnant. Those dividends continue to go up. It's just been such a great dividend-themed investment. And I think it's going to do fine, but I keep thinking that dividend yield growth has got to slow down eventually because they've added a lot of high yielding stuff to that portfolio that's done well. If you've been watching the channel, watching the Sunday videos where I'm looking at each of the different age tier stocks in the stock market, that tier 4 for the older income seeking investors, those stocks have been trading at a premium for a while right now. So is your stuff like Verizon and Altria Group and Con Ed, all of these, nice income producing stocks haven't been trading at a discount at all. In fact, they've been trading at a premium for quite a while. So, next milestones I'm looking to hit, you guys, obviously having an overall $2,500 invested. That's going to be a milestone that I hit here in about 3 weeks. So that's one of the short-term milestones that I can have my eye out for as another little minor victory to hit next. For my annual forward dividend income, I'm always going to celebrate every $40 increment. So when I can get this up to $80 of forward dividend income, that'll be exciting. And that's just because that every $40 represents a full week of active income that I'm investing into the portfolio every single Monday. So the more extra weeks of investment worth of dollars that I can get in that forward annual dividend income, the better. The first one, that first $40 took a while. The second $40 did not take as long because I've gotten a little bit of extra help from some dividend payments across the way. Not a ton, but a little bit. So far, just shy of $41 I've collected in dividends since I started this from the beginning. But what I'm really, really excited about is I know this number is going to hit $100 before the end of 2025. The question is, how much above $100 is it going to go? I'm not going to invest more. It's still just going to be that $5 a week into each of the funds, no matter what's going on in the market. But just doing that, I should, and with the dividends I'm going to get along the way reinvested, that's going to comfortably get me to $100. But hopefully all of these funds will do better in Q3 and Q4 than they did last year, which means that their dividend per share number will tick up, giving me a forward annual dividend income raise when that occurs. That's how it works, you guys. And then before I sign off, you guys, my other little side portfolio here that I'm also doing on SoFi, I am comparing the S&P 500 against an S&P 500 covered call strategy hand in hand to see which one does better. So I'm taking SPY, the biggest S&P 500 fund out there in terms of assets under management, versus SPYI or SPY-I, the NEOS fund that does covered calls and generally tends to produce monthly paying dividends in about a 12%, 11 to 12% dividend yield pretty consistently since its inception. S&P 500 itself certainly doesn't yield anywhere near that, but this is about what the S&P 500 typically grows in terms of share price on average every single year. So when it comes to investors, look, it's all about age and time horizon. So for me, if you're a very young investor, you are better off with the S&P 500 as your long-term play, primarily because you're not paying any taxes on the share price appreciation at any point in time until you end up selling. And if it's a long-term hold, you may not be selling your S&P 500 for multiple decades. Whereas if you're getting your 11-ish% a year return, primarily based off of dividends that are being paid out, you are paying taxes on those each and every year. Now, when you're at the point you can live off of the dividends, and that's your primary source of income, you don't mind something like SPY-I churning out a nice monthly yield and you just paying some taxes on that. Not a big deal, but when you are in accumulation mode, I do think that you should be leaning on growth for tax purposes alone, because you can always transfer the growth stuff over years later to current high yielding stuff. When you're at that point, you can attain that financial freedom. But what we've got right now, you guys, is it's a pretty close race between the two. They're both in the green. The S&P 500 is performing a little bit better overall when you factor in both share price growth and dividends reinvested. But if you look across the board here, we've got a $33 gain basically from our S&P 500 with about $4 in dividends and those being reinvested being a part of that $33 gain. If we look at SPY-I, overall our investment is up $29, but that's because we've received $51. Oh wait, I'm sorry guys, I'm looking at the wrong column here. Go back, bear with me. $33 in gain, but we've gotten $1.34 so far in dividends. I was reading off the forward annual dividend number, sorry. And then we've gotten $14.32 in dividends from SPY-I. So you see here about half of the overall gain of SPY-I has been the result of dividends, whereas about 90% of the gain in the S&P 500, if not a little more, has been the result of just share price appreciation, not the paltry dividend that it has paid out. So basically, you guys, in a market where the S&P 500 is more or less flat all year long, then SPY-I is going to do a lot better in years like this year and last year, where the S&P 500 is generally up and running hot. That's going to do better for you than something like SPY-I that generates the income. So again, for me, it's all about your age and your time horizon. Growth when you're young, transfer over to higher yield when you are older. And if you're starting out older, just start piling up the income producing stuff now. You don't have the time or the luxury to wait on some of the growth related stuff. You got to get that yield now. All right, guys, that is the great ETF race. Let me know how you feel like this one is coming along. Any predictions for where you think these ETFs are going to end up? Let me know down in the comments below. And until next time, let's keep that passive income rolling in.